Can you guys hear me? This is a test of the Emergency Broadcast Network. See if Jessica tells me if she can hear. Let's see. Yep, good to go. All right, we'll start in a minute here. I'm going to let it get to 1 o'clock, then we'll get this thing cooking. Okay, let's get this thing cooking here. All right, let's click this thing off. All right, welcome to 2023. Last year was quite a year, adventurous year for folks that were investing in the markets, all that kind of good stuff. So we're going to kick off and give you some ideas of what to look for the coming year. Hopefully it's a little less volatile. For me, it's been a rocky start. Had a little arthroscopic knee surgery a week ago Monday. So hopefully the stock market, it's moving along nicely. I'm feeling good about that. So maybe the market continues in a good way as we've seen so far. But let's kind of dig into this thing here. See if I can figure out how to press buttons here. So we've been doing this a lot the last couple of years. Ultimately, knowledge is power. We believe an educated client really helps our business, helps it when we try to manage portfolios. And we just want to keep you as up to date as possible with what's going on the ground. We've also been doing some 1 minute Friday sort of market minutes. So take a look at that. Follow our social media on LinkedIn, Twitter, and Facebook. And you can watch those as well to get an idea of what we're doing. So every Thursday, my investment committee gets together and we go over all the sleeves, the portfolio. And then so right after that, I want to try to give a few thoughts on what we're thinking real time so you can see what's going on. We go over this each time. There's 5 key tenets to financial planning. You've got preservation planning, retirement planning, tax planning, estate planning, and investment planning. So these are all things that we consider when we manage your wealth and your portfolio. But let's dig on into this thing. So it's funny when you look at 2021. So the first trading day of last year, the Dow Jones jumped more than 200 points. So it was looking like, hey, day one, we're back. We're gonna continue to do well. Record close to start 2022. Now, after that, we experienced one of the worst years that we've seen on record here. So last year, the S&P 500 was down nearly 20%. At its worst, it was probably down close to 25%. There was a pretty good rally at the beginning of the fourth quarter, and then December tailed off a little bit. But yeah, the last year was tough after we had a couple of pretty good years following COVID. But again, seasoned investors understand what's going on. While it's unpleasant and unwelcome to go through it, these types of things are part of the norm. So when you expand the chart out going back to 1980, you can see we've had these big pullbacks before. And even things like what you see here from 2000 to 03, that was basically a 50% decline in the stock market. And then the financial crash that happened just a year later. We've gone through these big things before, including COVID, and then we've just seen other periods where we've had these big pullbacks. So it's just part of investing as we know it. So things that we're looking at that we've been considerations. Inflation has been a big deal. That started last year, really. We saw it coming into play, hitting as high as a 9.5, but it's starting to work its way back. At least that's what the data is telling us. Doesn't necessarily feel like that when I'm in the grocery store or anywhere else for that matter. Interest rates, the Fed continues to rise. They did their lowest increase in February here with a 25 basis point increase. And we do expect them to continue. It looks like the target might be a little bit higher than that, so what we'll see. economic growth in certain channels has certainly been slowing. And then, of course, the weakening of fiscal and monetary stimulus. The Fed has truly backed off a lot of the stimulus they put into play. They don't want as much money in the system. And then global unrest, big deal. Have problems all over the globe right now. So again, when we look at the three major indexes, Dow Jones is a little bit more value bent. So that one did the best of the three last year with basically a 9% negative return. The S&P 500 had that 19.4. And for those of you that were tech heavy, NASDAQ really got hit hard. And that's just the tip of the iceberg. A lot of technology stocks looked a lot like the 2000 internet bubble, where we saw companies down 50, 60, 70, 80%. It was pretty rough going out there. And those were a lot of the companies that did well the previous couple of years. So again, when we look at last year and we see it's a bit of a roller coaster, you can see this chart. I don't know if my cursor is showing on there, but the year started rough. We had a bit of an increase, then another big pullback, then an increase, another big pullback, then an increase, rinse and repeat. And you can see here with the blue line starting in October, even though towards the end of the fourth quarter, we did have a little bit of a rally. When you look at the end of September, towards the end of the year, things did clean themselves up a bit. But even within the fourth quarter, you can see there that we had a degree of pain. So really, everybody saw what was going on with the equity markets. This is looking at inflation. So the inflation charts are kind of showing that we really hit a high around June of 2022 when inflation came in at 9.1. The numbers now are going down. The last report we had was from December, was at 6.5. We think that it might go up again when the next report comes out. So keep an eye on that. That could have an effect on the market and also ultimately what the Fed is trying to do here. Historically, we see the Fed slow things down when they can surpass where inflation is. They really want to get a hold of this thing, and it really seems like that's their mission right now. When we talk about inflation here, we're seeing pretty big numbers across the board. Again, when you go to the gas station, when you go to the grocery store, housing prices got out of control. Now, we expected housing prices maybe to fall a little bit more, but they're staying relatively stable, particularly because of the fact that people just aren't selling their homes right now. They've got great paper, they got good rates, so the inventory remains low, which is kind of keeping the housing prices up, even though rates are extraordinarily high. So that's kind of what we're seeing on the inflation side. So now, again, we talked about it. The Fed wants to raise interest rates as a way to battle. They want to make money a little bit more expensive. So we've seen rates go from all-time lows, basically at zero, to the Fed rate going up to 4.2 to 4.5%. We saw that quarter increase in February. Potentially we'll have a few more, but maybe going forward, we would be closer to the 25 basis point increase with a target of about 5.25, maybe 5.5%. But you can see right now we're at about 4.5 to 4.75. We still have a little bit ways to go on that. Now, the bond market is traditionally the safe haven within a portfolio. And what a lot of people don't understand is that interest rates have an inverse relationship with bond prices. So what do I mean by that? If you've got a $10,000 bond, let's say you bought it last year, a 10-year treasury bond, and it was paying a 1% interest rate. If you hold that bond to maturity, you're going to get your money back, presuming whoever issued it doesn't default. But you collect your 1% and then you get your 10 grand back is how it's supposed to work. Now, rates for, let's say, a 10-year treasury bond got as high as 4% as we saw things raised this last year. If the current bonds are paying 4%, but the one you own is paying 1%, if you needed to sell that, it's not a real attractive bond. Why would anybody want to buy a bond paying 1% if they could buy one that's paying 4%? So you can see what would happen is you would have to discount. You would have to sell that bond at a discount to make it attractive for anybody to want to actually buy that thing. So even though if you hold the bond to maturity, you're going to get your money back, the real-time value will drive the price down. And that works inversely too. If interest rates really start to sink from here, if you've locked any bonds in at some of these higher rates right now, they will become more valuable as interest rates sink. So that's kind of what this teeter-totter deal is. If you hear interest rates go up, figure your bond prices will go down. If interest rates start going down, the price of the bonds that you already hold in theory should go up. Let's take a look at treasury yields and where things have been at. Again, not sure if you see my cursor, but you can see when we looked at January of 2022, 5-year was at 36 bips, 10-year was at 93 bips, 20-year is $1.46, and 30-year is 166. You can see they've all skyrocketed up. 5-year, 10-year, 20-year, 30-year, all paying much higher rates as of December 2022. The short end of the curve is paying even better than that, and that's an area that a lot of people have been parking in, at least that we have. Money market rates, if you are not paying attention to your bank accounts, you're probably losing a lot of money. If you've just kept it in checking or you don't have a high interest rate savings, a lot of the banks are still pretty low. Obviously, they're much higher than you can see where they were a year ago, but if you have questions about that and want to start getting a better interest rate, see us for sure, because there's a lot of good things that we can do on this front. So again, we are going to continue, even though we've had a nice little rally to start the year, we still think it's important to proceed with caution here because there is a lot of instability and things that are going on out there. So we want to kind of help you make better decisions here. So let's just take a look, even though we're going to continue to be cautious. If we're just going to look at some charts and see how things go, how did the stock market do after a recession? Now, I don't know if we're necessarily in a recession yet. Everything points that we're probably headed to a recession toward the year end, but it's important to see the stock market has responded pretty year when you look at the 1 years, the 2 years, and the 3-year numbers after a recession. So that's why you're going to hear from myself and a lot of other folks that for the most part, you want to try and ride through these things. Now, you know, I mean, none of this is guaranteed. Doesn't mean it always does this, but historically, this is what we've seen. What do we expect? And I talked about it a little bit already. We do expect more interest rate hikes. Borrowing has become much more costly. If you're getting a loan today, it's much more expensive than it would have been a year ago. Also, be sure to look at your income producing investments. If you're not getting a good yield, there's a lot of opportunity out there right now. And again, as always, you want to practice patience. You want to focus on the long term. Don't get caught up in a short-term panic and hysteria that can happen. If you're ever concerned about anything, you always want to give us a call. So some takeaways, the bear market could continue. You know, I hope not. I hope it's just all green from here, but you got to be cautious. Revisit your budget, see what's going on, determine what you need versus discretionary. If inflation continues to go in a realm, it's very expensive to go in a grocery store right now. So a lot of discretionary purchases have been laid off by people. Things that you don't need, maybe you're not getting right now. Make sure you have a well-devised plan. So for those of you that aren't working with us, give us a call. We'd love to help you. And we're, again, proceed with caution. We are here to help you. So again, remember, if you got a short-term goal, it's probably important to be safe, but you've got something a little bit longer term, riding through it does make a lot of sense. So those are kind of our outlook looking backwards. Now, with regards to some ideas from a proactive tax planning perspective, again, we always want to be proactive rather than reactive. And so there was a pretty significant change that we saw recently. We had the Secure Act 2.0 that have brought some provisions in that I think are going to be pretty attractive for a lot of folks. So we're going to dig into some of those and also some traditional tactics that may help you as well. So let's see where we're starting right now. The 2023 tax brackets have not changed. These were the brackets that Trump put into place. I want to say that was 2017. It would have appeared when Biden first got in office, he was really aggressively trying to get these changed, but could not get them changed. They will grandfather out, I believe, in 2025, or 2026, somewhere around there. These things will grandfather out, and then we'll have a whole nother debate. But we're still in pretty favorable tax brackets for single filers, married filers, those type of things. So with tax season coming up, you'll be going over this with your accountant. The capital gains rates continue to be pretty attractive as well. Oops, I think I pressed the wrong button. You can see here that there is a 0% tax capital gains rate if you fall in one of these income brackets. So those are important things to look at to see if you fall, and say for some reason, unfortunately, you lose a job or income is down for a year, it could be opportunity to sell some things in a portfolio. So know that most people fall in the 15% bracket. And then of course you may see some folks that have to pay 20%. Also be aware of your local state laws. In California, They don't necessarily have a capital gains tax. Everything is going to be taxed at ordinary income. So even though you may be in a 0% rate over here, you might have to pay at your local state level. So stay in touch with your accountant on that front. Retirement plan limits have gone up. So this is important if you're putting money into your 401k plan. For those of you that are under 50, you can now get $22,500 a year into your 401k. If you are over 50, there's a $7,500 catch-up. So that means you can get $30,000 a year if you're over 50 into your 401k plan. If you're looking to aggressively save for retirement, it's good for you to get on this at the beginning of the year so that you didn't leave anything on the table when November, December comes around. Because again, when you put money in through a 401k, it has to be withheld from your paycheck. You can't just cut a check like an IRA or anything along those lines. Again, for those of you that are in a little bit more eclectic plans like simple IRAs, those have gone up as well to $15,500. Catch up there is $3,500. We're doing traditional IRAs or Roth IRAs. That's gone up from $6,000 to $6,500. Catch up is $1,000. And then for defined contributions, you can get as much as $66,000 in with the catch up. So there's a lot of opportunity for you to save if that's something you're looking to get on. Okay, the exclusion gift. So now you can gift folks $17,000 a year. Again, everybody has a lifetime exclusion. If you go above that $17,000, you have to use part of that lifetime exclusion, or there's been a pretty punitive 50% tax that we've seen historically. So if you're in the business of giving money away, the $17,000 is where you're at right now. So ideas on where you could put that, potentially if you have a working child or grandchild, fund an IRA or a Roth IRA. Also, you could gift into a 529 plan, which has been very popular as well. And that's going to be something exciting we'll be talking about too a little bit later. So again, let's kind of get into some more proactive stuff and specifically into the Secure Act 2.0. The original Secure Act was passed a few years back under the Trump administration, and it attacked a lot of retirement plan issues. And so this one follows in suit, and there's some pretty good stuff in here. So first and foremost, for those of you that are getting into the RMD age, the original, before the first Secure Act, it was 70.5. Now we're up to 72, and it will now go to 73. So if you are turning 72 this year, you can delay your RMD one more year. If you have already started your RMD, it's too late, you're in, that's the deal. But if you have not started yet, you're going to turn 72 this year, then you'll get that year off here. So it's just delaying what you have to take out. So for those not familiar, a required minimum distribution has to do with your IRAs and your 401ks, any type of retirement plan. The government at some point will say, hey, we want our taxes. Now it's time for you to start taking money out of these plans. So this is the longest you can delay. Then there's a calculation that we do. It tells you actually how much you have to take out. Now, this is interesting. You don't usually see anything fall on this side, but in the past, the penalty if you did not take your RMD was a 50% penalty. So if you were supposed to take $1,000 out and you didn't, then the penalty would be $500. That is going to be reduced to 25% rather than 50%. And then again, there's a provision here that says if you are able to correct it in a timely manner, the penalty would be 10% instead of 25%. So that's a big deal. Most people, when they don't take their RMD, it generally is an accident. Maybe they weren't getting good counsel. Maybe something slipped through the cover. Who knows what it is? So this is a nice provision to have. This is a qualified charitable distribution. So a lot of times folks don't need their RMD. So they're perfectly fine with the income they have, and they have to pull out $10,000 from their IRA. Well, maybe they don't want to pay income to that. So here we can look at qualified charitable distributions where we can gift directly from the IRA to the charity. That way you can avoid having to pay that income tax and get the money to a charity that is appropriate for you. What we got here? Turn that off. This is good too. If your company offers a STEP or a simple IRA plan, we now have the opportunity to get to, or we will have an opportunity starting in 2023 to use a Roth. So again, a Roth IRA, a lot of people are not eligible because they get phased out income-wise. When it's through a company retirement plan, there is no phase out. So you don't have to worry about what your income is. So if people are looking to tuck money away into a Roth component, these will be new provisions that are coming out this year. This is probably the most exciting item that I've heard of here. This may be French for a lot of people here, but a 529 plan, we've talked about it in the past, is a college savings plan. It's a way for you to save tax-free for your child's college education. You put the money in. Most states you don't, or at least California, you don't get any type of tax break. Some states have a tax break, but nothing on a federal level. So you put your money in, and if you use the money for a qualified education expense, then it comes out tax-free. So it's fantastic. Well, they put a provision in here if you have money left over or just have money in there, you have the potential to convert that 529 to a Roth IRA. Now, this is brand new. We're still digging into it, but from what we can see, you have to hold the 529 for 15 years. It has to go into the name of the beneficiary. So this would go into your child's name, or whoever is the beneficiary of it. And it looks like there's some sort of lifetime limit of 35,000, and you also have to stay within the realm of what you can contribute to a Roth IRA. So we're going to keep our eye on this. This wouldn't take effect until 2024 anyways, but should this get hammered out in a good way, this is awesome. It could turn out to be a backdoor Roth IRA solution for folks. Maybe there's even a way that we can, name yourself as a beneficiary, so you set up a ways for folks to get additional money into Roth. So all that is speculation at this point right now, but this is something that's really important that came out of the Secure Act. Now, we always talk about Roth conversions. It's generally one of the hot topics anytime someone comes to see us, like, when should we do it? When should we not? Ideally, the matrix is you want to be in consideration of who's going to get it if you're looking at it from a family tax management strategy. So, when you look at this chart here, if your tax bracket is higher than your child's tax bracket, then it probably doesn't make a lot of sense to convert an IRA to a Roth, because they will pay less when they get the IRA later. But however, let's say your kids are very successful and you're on the decline, whatever it may be, and your kids are in a much higher tax bracket than you, then potentially you could convert an IRA to a Roth at your lower tax bracket, and they can inherit it at a higher tax bracket later. Again, this is not commonly used, but it's a way, if you're looking to manage your taxes from a family perspective, to be the most efficient as possible. What are the benefits of a Roth conversion? It does lower your overall taxable income. You get the tax-free compounding. There are no RMDs on a Roth IRA. And then again, when it ultimately does get to the beneficiaries, they will come out tax-free. So if you're interested in that, you'll want to talk to your accountant about it, but definitely talk to us about it as well. Donor advised funds are a nice way for you to get money to charity. If you have highly appreciated stock, you can move that into a donor advised fund, which is sort of like a collective. And then you take that donor advised fund and you utilize it to give to various charities that you want. So if you're an individual that is sitting on some highly appreciated stock and are charitably inclined, these funds are nice, where you can just kind of get it in there and then figure out where you want to give it to afterwards. We talked about the qualified charitable distributions. Even though the RMD has started at 73, it will be 73 now. You can still do this at age 70 and a half, which is the old RMD number. So if that's something you're looking to do. So if you're just turning 70 and a half this year and you want to start getting on that, you can certainly do that. So we're working on our tax report. That should be out soon. If you'd like a copy of that, let us know, and we can get that out to you. We generally try to publish that on our website as well, but we do send it to clients. So, but if you don't get it, let us know. This is all the compliance stuff. It's important that I keep this up so you can read it, memorize it, understand it. There will be a test. I expect you all to email me all the intricacies you can find about this compliance related stuff. It's very important. In case that you didn't have enough time to read all that, just email me and I will send you all the compliance information so you have a true opportunity to read that. But ultimately, at the end of the day, we greatly appreciate all of you. We have had we're very blessed to have a great client base here. Last year was trying on everybody, but we really felt we held things together for the portfolios and our client base. and did a good job of keeping things intact in consideration of what was going on last year. And we got a lot of compliments through referrals, and even year to date, we've already got 9 introductions for new families that we're able to help. So definitely keep us in mind. Someone at some point or another introduced you to myself, or even in some cases to my father. And if you've been happy with us, we just don't keep us a secret. We'd appreciate that. But yeah, if you know anybody that would want to sit, we're going to do a couple more of these presentations. And then we also have our newsletter. And then again, we'll be doing some stuff for taxes. We'll have our quarterly updates and those type of things. But if anybody has any questions, I think there is a little button you can press at the top here. Let's take a look, and I'll see if anybody has anything in there. If you do, feel free to put that in there. And then, of course, keep a look, LinkedIn, all that kind of stuff. You can get a good idea of what we're thinking about right now. We're trying to put that information out for you so you can keep an eye on it. So this year's looking a lot better than last year, that's for sure. And so we'll see. Hopefully it continues that way, but who knows for sure. All right. If you have anything else, just drop me an email, and then we can go from there. Have a great rest of the week. See if we can turn this off.